August opened up with a bang for the markets with the dollar-yen carry trade sell-offs that happened, and calm has somewhat been restored. The dollar has pulled back significantly as well, and this all comes ahead of the Jackson Hole Symposium this weekend, and it also comes ahead of what is now surely a done deal of rate cuts set to start in September. And so apart from some questions popping up about the US labor data, it seems like markets are gearing up for a much calmer end to August. To chat with me about the events and how, just to give a snapshot of where things stand at the moment, I'm joined by ETM Analytics market analyst Andrew Hyde. Andrew, thank you very much for joining me. We saw the market shock at the beginning of the month really being sparked by, very bullish sentiment around the yen. Is that still the case?
Hi, thanks, Ilza. Yes. So the outlook on the yen is still bullish, although carry trade has been unwound for the most part. So we actually don't see any more volatility coming from the yen or from FX markets unwinding these carry trades. And the reason being is that the Bank of Japan has clearly highlighted that it understands the effect it's had on FX markets, and it has signaled that it's not going to proceed with any rate cuts in the very near term, although looking further out, surely, and we do expect that the Bank of Japan will continue to hike and continue on that process of normalizing its monetary policy. And to that extent, we've seen the speculators, the non-commercial speculators, they've turned more bullish on the yen, but we don't see any more volatility coming from those markets.
The carry trade sell-off wasn't just sparked by a bullish sentiment around the yen. It came at the same time as the markets turned more bearish against the US dollar, sparked by, recession concerns, economic growth concerns, labor market concerns, equity market concerns, and obviously also the rate cut expectations that we now kind of think is imminent. Is this bearish sentiment around the US dollar, is that still persisting?
Absolutely. If anything, we've seen these markets double down on this bearishness towards the dollar. In fact, the cost of hedging against dollar weakness, that has become more expensive than it has for dollar strength, really highlighting a shift in sentiment towards the dollar. And it makes sense given the macro environment we're in. We are expecting the Fed to start cutting soon. In fact, it might be as early as next month. And we've seen the dollar weaken also in the spot market. So the dollar's been weakening over the last week or so. It's it's really more pronounced. This came on the back of weaker producer and consumer data, inflation data out of the US. And then towards the beginning of this week, we saw markets start to price in and square up their positions. The Jackson Hole Symposium that starts on Friday and goes into the weekend. And there's really a lot of market moving potential with the Fed set to kind of lay the groundwork for its rate cutting cycle. And certainly there's a lot of sensitivity in the market, and traders and investors are just shoring up their positions so that they don't incur any real big losses. But they also are anticipating that there might be a little bit more volatility injected with some commentary that might be the first time that we hear it in this current cycle.
So we checked actually just before we came in, markets currently pricing in 8 rate cuts of 25 basis points up until the end of 2025, right? So that's how much? 200 basis points in total for the cycle to come. So, this obviously comes before the Jackson Hole Symposium, where I'm sure investors, they're going to take a tweezer to Jerome Powell's speech to dissect any sentiment, because the question has shifted from when rate cuts will start to, like exactly what we spoke about now, what we can expect, how long, how much, how deep will the rate cuts be. And the all-important question is, of course, did the Fed manage to engineer the soft landing that they have been preaching about for the past 2 years, okay? And a big part of the Fed standing their ground against, rate cuts was the stronger labor data. Now, at some point, for any market watcher, at some point in the past 2 years, you would have gone and said, something about this labor data is not adding up. It's just holding up too strong. It doesn't make sense. We all had that question pop into our minds at some point or another, and here we are. We were right. It did not add up.
And here we are. So This is exactly right. Since early days last year, we've been pointing at labor market data in the US that actually doesn't make sense given the conditions that we knew to be true. And we found this really interesting, and we did a lot of coverage on it. But only recently have we gotten a kind of a vindication.
Yes.
And, you know, the US economic cycle, it is turning, and that has been bolstering the case for the Fed to cut interest rates. Just the last MPC or FOMC minutes that we saw from the Fed for July, there was some signals that those members, those policymakers have turned more sensitive to the labor market, and it makes complete sense. So the Bureau of Labor Statistics out of the US, they've now revised their payrolls data numbers, and those numbers have been revised downwards by about 800,000 jobs. So from April 2023 to March of 2024, they've revised the total number of jobs down quite significantly. And I think that actually highlights that there is a lot more softness in that labor market than what those previous numbers have suggested. And this has just let the markets kind of cement those expectations.
That's right.
And they've really taken that to be a signal that the Fed has turned really sensitive to the other half of its dual mandate, which is, of course, the employment. And we expect to get some insight and some confirmation on that this weekend with the symposium.
That's right. So it's worth noting as well, the revision it was only done up until March, right? So the possibility of further reductions to those numbers is definitely still a possibility, which means the labor market could even be softer than where it stands now. So it's going to be an interesting weekend. Barring a black swan event, I think the markets are geared for a calmer end to August, but who knows? Anything could happen overnight. But Andrew, thank you very much for joining me, and I'm sure we will chat again soon.
Cool, thank you.